So what are corporates doing in terms of buybacks and CAPEX? And it's key because this will help us understand the true prospects for future economic growth and whether it can differ from the pre-pandemic levels. What are you seeing in terms of trends in both buybacks in the US and also in CAPEX at the moment?
Well, Roger, we saw in 2019 and 2020, we saw, the rise of both CAPEX and the buybacks, right? They kind of have moved a little bit higher. No gigantic shifts, but then as 2021 started, everything's kind of pulled back, which is interesting. 2020 was slightly off from 2019, but then the CAPEX has pulled back even more as we moved into the first quarter of 2021. And a lot of what we're seeing from the buybacks is also an increase in the programs that have been announced coming off of these Q1 earnings reports. So it's been quite a large shift back into the traditional buyback program and or shareholder return, let's call it, buybacks and dividends. And a theme that I've seen across as I go through a lot of the calls is 50% shareholder return is what a lot of these companies are starting to target. So it's an interesting number that's kind of continuously coming up.
I mean, it's quite a decent chunk of the S&P or the Russell, various parts of the indices. These are actually adding up to quite serious sizes again.
Yeah, the numbers behind everything were quite interesting. You're talking, I think it was somewhere north of 100 different companies announcing a program, and then there was another, let's say, 100 or so that were looking at things a little more strategically. They don't have an official plan, but they're looking to invest where possible. So it looks like we're going to have an increase, a quite sizable increase in buybacks as we move into 2021 for the rest of the year. We're talking close to 2% of the market cap of the entire S&P 500.
Last year was really focused in a lot of those technology names because they were the cash-rich tech companies. Is it kicking off again this year that the tech companies are leading the charge in terms of buybacks?
We have the traditional names. You have Apple. Apple's about a $90 billion program announced the last quarter. Google, $50 billion. Then you kind of come down. And what's been actually surprising from the buybacks are the banks are starting to step in, right? So financials is the number 2 announced. And what I noticed is they're not going too far out. So a lot of the other programs that have been announced are for the entire year, whereas the financials are only looking the next 3 to 6 months because of all the regulations that they have to follow. But they are the number 2, but technology is the largest.
But on the CAPEX side as well, I mean, last year, I think if we look year on year, we started at a better rate, but isn't that heavily skewed to, I think it's the gap CAPEX for Verizon? Otherwise, CAPEX looks like it's flat. So no one's really gearing up for this, woohoo world of big growth and excitement at the moment.
Yeah, that was the most interesting thing I noticed when going through the data, and you kind of alluded to that with Gap, is when we compare our IBIS estimates, which come from the brokers, they look to be non-GAAP, and they're not accounting for some of the acquisitions in the telecom wireless space. So AT&T, Verizon, T-Mobile purchased a large percentage of the wireless technology, and that's a huge number that's appearing in the GAAP CAPEX. But after that, it's Amazon has a decent amount of CAPEX going into Q1, and you're looking a little bit at some of so GM had a little bit, and I think Ford just announced another one in addition to their CAPEX going into the EV space. So that's really it. That's been quite reserved.
All this inflation talk and all this growth talk and reflation, you'd have thought that maybe companies would be going, right, we're going to tap into that by doing more CAPEX, but it seems that what they're doing is CAPEX is nowhere, is not up on the previous year, pre-2020 either. It's sort of flat, maybe slightly down. Buybacks are coming back. So it seems that although the corporates are talking a good game in terms of mentioning inflation as a problem or a reason to raise prices, none of them are actually doing anything that suggests that they're investing for long-term growth. It seems like the CEOs are playing this as if it is transient, that this is just short-term inflation and buybacks and no CAPEX will be better for the longer term.
No, I agree, and I think I mentioned some of the surprising things when we were talking about this is, and even something like energy, right? So we've seen talks on Real Vision about oil and some of the squeezes, we'll call them there, in commodities. A lot of these companies are still not investing enough in CapEx to drive us into that next level in 2022 to kind of limit the amount of pricing. Energy had traditionally been a growth area for CapEx. That's where they did a lot of spending, but they've been bit over the last 5 years or so, where the pricing is so low, and I think they're a little hesitant to spend that money and bring us back to a normal kind of production level. So I think they kind of have these alligator arms, as they like to say. They're a little afraid to get out there and get their hands bit off if they invest too much. They're being very, very cautious with the way they move forward.
This is all suggesting that reflation story may be not as robust as we think, whilst at the same time the tech companies still have loads and loads of cash, are still doing billions and billions in buybacks, and actually trying to fade the tech companies in this value growth rotation may actually be quite dangerous, given that this backdrop suggests that actually we'll see a return to tech buying themselves, buying their own shares, reducing their free float, and pushing their share prices higher again.
Yes, and I think if you think about it historically, why is a company bought back is to improve the stock performance. So regardless of what happens as a business, if they're investing in the retiring shares and increasing the dividends, that's going to attract more and more investors, especially on it's a increased yield. And as people try to find yield, that's a quite attractive place to put your money, is in these tech companies that they not only have growth, but they're also giving you some return on that investment as well.
Yeah. So sort of to summarize, it just seems from the data that we're in this mad world of everything seeming so completely different, and yet the corporate world is actually kind of just carrying on the same, taking the higher prices where they can, but in terms of how their corporate style, in terms of longer term thinking, buybacks, CAPEX, it all looks like the old trend is still the old trend, which is the new trend, and it hasn't really changed much.
It's back to the old way. All they've done is, if you think about it, they've kind of mirrored the consumer. They've reduced their debt slightly, but they've increased what's in their savings account, and they're kind of just waiting to see what happens. I think a lot of them are letting this play out, and they're going to do what's best for how they're measured.
What Mike is seeing in the data is a corporate sector that seems eager to return to the pre-COVID trend of buybacks to help performance, rather than investing today in anticipation of future growth. CAPEX plans are not meaningfully picking up outside of some sectors, which are distorted by M&A activity. Whilst many are concerned about high yields hurting the tech stocks, it's these names that are leading the charge in the buyback space, which suggests it's going to need a particularly big move in yields to dethrone their long-term market leadership.